What is going on at the Credit Suisse? Credit Suisse is once again in the news, and all for the wrong reasons this time. The stock fell at a record low of 3.52 Swiss francs, owing to a sharp increase in the cost of insuring its debt against bankruptcy. Credit default swaps CDS now show the market at a pricing in a 23% chance that Credit Suisse will go bankrupt within the next 5 years, prompting inevitable comparisons to Lehman Brothers in 2008. The global financial crisis peaked in September 2008 when the subprime mortgage debt market collapsed, forced Wall Street investment banking giant Lehman Brothers to declare bankruptcy. The big picture. Financing conditions have tightened in general since global central banks began raising rates, with investors particularly concerned that the Federal Reserve aggressive action will result in a hard landing. To make matters worse, a winter energy shortage in Europe is expected to spark a severe recession. With markets reacting extremely sensitively, UK Premier Liz Truss' radical unfounded tax cut plan resulted in a rout in the currency and sovereign bond markets in the United Kingdom. The Bank of England was then forced to commit to a $74 billion intervention after reports that the unexpected swing caught the market off guard and threatened to harm pension funds with $1.7 trillion in assets. Overall sentiment in capital markets is thus quite volatile, particularly in the financial sector. Signs of impending danger. Unfortunately, major Credit Suisse shareholders, such as Harris Associates portfolio manager David Hero, believe that the markets are quick to punish the Swiss bank in particular whenever there is a broader trouble. This is due to the fact that it has supplanted Deutsche Bank as a primary source of instability in Europe's aligning banking industry. The lender has been dubbed Debt Suisse after an 18-month string of scandals and embarrassing executive departures, including those of ex-chairman Antonio Horta Orsola and former CEO Thomas Gottson. The bank's market capitalization has dropped to roughly a quarter of its tangible book equity of 42.5 billion francs. That is, its stock is valued at a significant discount to the total of Credit Suisse hard recoverable assets, which can be liquidated to cover debt in the event of a collapse, which is usually a sign of extreme distress. When this record high CDS price may be another sign of trouble, it is important to remember one important aspect of this asset class. Anyone can buy them. Hedge funds, which frequently use excessive leverage to fund their speculative wagers, can bet on a default whether or not they own the underlying debt. As a result, experts have frequently compared it to purchasing insurance in the event that your neighbor's house burns down. It can create a perverse incentive to commit financial arson. The catalyst. With markets volatile and its reverse of confidence nearly depleted, Credit Suisse has proposed its third restructuring plan since Gottson took over in February 2020. The problem began on September 23rd, when Reuters reported that the bank was in talks with investors about raising capital to cover the cost of shrinking its investment banking operations. According to some analysts, this could require up to 4 billion francs, which is more than a third of the bank's current value, and shares are sold off that day. Credit Suisse then unintentionally exacerbated its problem when an internal memo from the CEO, Urge Corner, was leaked on Friday, in which he stated that the bank had a strong capital base and liquidity position. The real danger for global investors. A potential wipeout of Credit Suisse shareholders would be a shock, but it could be manageable in the larger scheme if the fallout was contained. The risk to global investors is a domino effect, in which the lenders are forced to write off large exposures to their Swiss counterpart, causing cascading uncertainty across the sector. Transparency about the types of risk a bank faces through its trading book is critical for assessing contagion. The preponderance of financial assets structured for tailor-made bets that were so illiquid that banks could only value them based on untested theoretical pricing models was one of the causes of the 2008 crash.